Options trading. You've probably heard the term, and yeah, it can sound pretty intense, maybe even a little complicated. But what if I told you it's a lot simpler than you think? Today, we're going to cut through all that noise and show you the basic building blocks of options using a really cool framework that might just change how you think about your investments. So let's dive right in. All right, let's start with something we can probably all relate to. You know, the classic buy and hold strategy, right? You find good companies, you invest, and you let that sweet, sweet compound interest do its thing for, decades. It's a solid path, for sure, but let's be real, it can feel painfully slow sometimes. Okay, so if long-term is too slow, what's the other option? You jump into the wild, fast-paced world of day trading, right? Well, that's a whole other can of worms. I mean, check this out. Financial authorities have actually found that a massive 89% of investors in certain short-term high-risk products, well, they lose money. That's a statistic that should make anyone pause. And this, right here, is where options enter the conversation. They're often seen as this potential middle ground, a way to shoot for higher returns, maybe a bit faster than buy and hold, but with a totally different approach to risk than just gambling on day trades. So, to really get this, we've got to strip away all the fancy jargon and get down to the absolute basics. An option, at its very core, is, well, it's just a contract. That's it. Nothing more than a simple agreement. So what's actually in this contract? It's just an agreement between two people, a buyer and a seller. They're making a deal about potentially buying or selling something, like a stock. And the really important parts are that they lock in a price and they set a deadline. At its heart, it's just a deal with a time limit. Let's make this real. Let's meet our two parties. We've got Tom, the buyer, and Alexa, the seller. They're making a deal over 100 shares of some stock, we'll call it XYZ. They agree on a strike price of $60, and they set the expiration date for April 1st. Now, for this whole agreement to happen, Tom pays Alexa a little fee. We call that the premium, and in this case, it's $5. See, they're just the specific terms of their deal. Okay, now if there is one single thing you remember from this entire explainer, please make it this. Tom, our buyer, pays that premium to get the right to do something. He has the choice. He doesn't have to do anything. But Alexa, the seller, she gets the premium, and in return, she accepts an obligation. If Tom decides to use his right, she has to follow through. This right versus obligation, that's the absolute key to understanding everything else. All right, now that we got the contract, there are really only two flavors of options you need to know about: calls and puts. Think of these as the Lego bricks for pretty much every option strategy out there. First up, we have the call option. A call gives the buyer the right to buy the shares at that price they agreed on. A little trick to remember it, you're making a call to call the shares over to you. You'd typically buy a call if you think the stock's price is going to go up. And on the flip side, we've got the put option. This gives the buyer the right to sell their shares at the set price. You can think of it as having the right to put your shares onto someone else. And you'd usually buy a put if you think the price is about to go down. So let's connect the dots. We've got two types of options, calls and puts, and you can either buy them or sell them. That simple math gives us four fundamental traits. This is where the rubber meets the road. Okay, let's go back to Tom. For our first trade, he buys a call. Why? Because he's bullish. He's betting the stock price is going to shoot up. He pays his premium, which buys him the right to purchase that stock for $60 a share. So if the stock suddenly jumps to $80, he's looking pretty good. And here's how the money works out. Tom uses his right, his special privilege, to buy the stock for $60, even though anyone else has to pay $80 for it on the open market. That's a $20 win right there. Then you subtract the $5 premium he paid for the contract in the first place, and he walks away with a $15 profit per share. And there you have it, a clean $15 per share gain, all because he correctly predicted which way the stock was heading and used the power of a call option. Now, let's not forget about Alexa. What's happening on her side of this exact same trade? Well, she's the one who sold that call to Tom. She was bearish. She was betting the stock would stay put or maybe even drop. Since the stock went up, Tom used his right, and now Alexa's on the hook. Remember, she has the obligation to sell her shares to Tom for that $60 price, even though they're worth $80. Ouch. Now, she did get to keep that $5 premium Tom paid her, which helps a little, but she still ends up with a $15 loss. It's the perfect mirror image of Tom's profit. Okay, let's switch it up. What if Tom thinks the stock is about to tank? Now he's bearish, so he buys a put. This gives him the right to sell at $60. So if the stock plummets down to $40, he's a winner because he gets to force someone to buy it from him for way more than it's actually worth. And that brings us to our fourth and final basic trade. Alexis sells that put to Tom. She's bullish. She's betting the stock is going to stay above that $60 mark. And if she's right and the stock price doesn't drop, Tom's right to sell is worthless. The contract just expires, and Alexa gets to keep the premium free and clear. Her obligation to buy only ever kicks in if the price actually falls. So those are the four cornerstones. Pretty straightforward, right? But how do you actually combine them into a strategy you can use? Well, let's look at a popular one called the wheel, which is all about trying to generate regular income.
You can think of the wheel as a continuous cycle, like a Ferris wheel that just keeps turning. The whole point of this strategy is to be the seller, to be like Alexa, and just consistently collect those premiums week after week or month after month. It's a strategy that's totally focused on creating cash flow.
Here's the play-by-play. Step 1, you find a stock you actually like and wouldn't mind owning, and you sell a put on it. Bam, you immediately collect a premium. Now, if the stock price stays up, you just keep the cash and do it again. But if the price drops, you get assigned. You have to fulfill your obligation and buy 100 shares. No problem. That just brings you to step 2. Now that you own the shares, you start selling calls against them, collecting even more premium. If the stock then goes up and you get assigned on the call, you sell your shares, and guess what? You're right back at step 1, ready to sell a put and start the whole wheel turning again. Now, a strategy like this can be a really powerful way to generate income, but, and this is a big but, it is incredibly important that you do it responsibly, especially when you're just starting out. So let's go over the golden rules. Listen, this is the most critical part. To sell a put, you absolutely must have the cash sitting in your account to buy those 100 shares if you get assigned. It's called a cash-secured put for a reason. And to sell a call, you must already own the 100 shares. That's a covered call. This isn't about making wild, risky bets. It's about only making promises you can keep. And, just as important, you should only ever use a strategy like this on high-quality stocks you would be happy to own for the long haul anyway. So let's wrap this up. We've broken down the simple contract, we've walked through the 4 basic trades, and we've even looked at a real-world strategy for generating income. You see, the ideas themselves aren't nearly as scary as they seem at first. So the real question is, now that you have these building blocks, what if you could use them to take a little more control over your own financial future? Thanks for joining me.